Take two identical workers. They have the same job, they earn the same salary, and they invest the same amount of money every single month for 30 years. This chart shows how those identical paths can lead to two different versions of retirement. One ends with $400,000, the other ends with $612,000. That is a $212,000 gap between two people who made the exact same financial sacrifices. The gap is the cumulative result of tax friction. Depending on which account these workers chose, the government either takes its cut at the beginning or waits 30 years to claim a significantly larger portion at the end. To avoid that loss, you need to understand the internal logic of the tax code. I'm going to show you a specific sequence for your investments, starting with what you should do with your next paycheck. HR departments usually present the 401k and the Roth IRA as simple checkboxes on a form. But because of how compound interest interacts with tax rates, that choice determines how much of your final balance you actually get to keep. For most people, wealth building starts with the 401k. This is an employer-sponsored account designed to intercept and protect your income before the government has a chance to tax it. This diagram demonstrates the immediate benefit. If you contribute $500 a month to a 401k, that money is deducted from your gross pay. Your taxable income drops. If you are in the 22% bracket, that deduction saves you over $1,000 in taxes this year. Once inside the account, those funds grow untouched by annual taxes. They compound for decades without the government taking a slice of your dividends or capital gains. But the government eventually collects. When you retire, the IRS requires you to start taking withdrawals, known as required minimum distributions. Every dollar you withdraw is taxed as ordinary income at your future tax rate. The system allows you to build a large balance before that happens, with the IRS permitting up to $24,500 in annual contributions as of 2026. The 401k is a delay tactic. You secure a tax break today in exchange for a mandatory, potentially larger tax bill in the future. The Roth IRA operates on a different logic. It is an independent account funded with post-tax money, cash from your take-home pay that has already been taxed at your current rate. Because you pay the tax up front, every dollar of growth and every future withdrawal is immune to taxes. You keep 100% of what you earn, regardless of how high tax rates climb in the future. Look at a worker investing $6,000 a year for 35 years. Both accounts reach $946,000. But when it's time to withdraw, the Roth balance stays whole. The traditional 401k is slashed by $208,000 in taxes, assuming a 22% retirement tax bracket. The Roth also provides unique flexibility. Since you already paid taxes on your original contributions, you can withdraw that principal at any time, for any reason, without taxes or penalties. By paying a small toll today, you guarantee the government can never touch your compound growth again. Choosing between them depends on your tax bracket. If you are early in your career and in a low bracket, use the Roth to lock in low taxes. If you are at your peak earning years and in a high bracket, use the 401k to take a deduction now when it is most valuable. However, high earners are often blocked from this choice. If your income exceeds $168,000 as a single filer or $252,000 married, the IRS prohibits you from contributing directly to a Roth IRA. High earners use a maneuver called the Backdoor Roth. This involves making a non-deductible contribution to a traditional IRA, which has no income limits, and then instantly converting those funds into a Roth IRA. If you already have pre-tax money in other IRAs, this move can trigger a tax bill through the pro rata rule. Always check your existing balances before attempting a conversion. While the government uses income brackets to limit your options, these legal workarounds ensure that tax-free growth remains accessible even at high income levels. Before you prioritize either account for its tax benefits, you have to address the foundational element of the system, the employer match. When an employer matches your 401k contributions, they are providing a guaranteed 100% return on your investment. This is capital added to your net worth before your money even reaches the market. According to Vanguard, roughly 25% of Americans with access to a match fail to contribute enough to receive it. Ignoring the employer match is a massive drain on your future wealth. It is the first priority in any retirement plan, regardless of your tax strategy. You can coordinate these tools into a 3-step sequence to maximize both free money and tax efficiency. First, route your investment dollars into your 401k exactly up to the match limit. This ensures you capture every dollar of free capital offered by your employer. Second, route your next $7,500 into a Roth IRA. This builds your tax-free vault, protecting your most aggressive long-term growth from future IRS claims. Finally, if you have remaining funds, route them back into your 401k to utilize the rest of the $24,500 pre-tax limit. Used together, these accounts act as partners to protect your wealth. Starting this sequence today is the only way to ensure that when you reach the end of 30 years, you are the one retiring with the full $612,000.
वीडियोस बनाने हैं, फिल्मोरा है ना।